Hello, everyone. My name is Wes Hedrick. I'm a private wealth advisor here at Westwood, and joining me as a moderator is my colleague and marketing associate, Haley Bork. During our call today, we hope to explain the higher cost of higher education and funding options and how to approach planning for future education costs.
Yeah, thanks so much, Wes. I'm excited we're here. I think this is a great topic to focus on, especially at this time of the year. So, if you want to just get right into it, I think we can talk about kind of the rising costs of higher education. I know you have some slides, so we can kind of look at what it means to parents and grandparents of these young adults and children, kind of looking on how to prepare, incurring for these expenses in the future.
Absolutely. Thanks, Haley. I'm going to share my screen so that we can
Sounds good.
see the slide. Okay, so this is a slide that we put together, we as in the financial planning team put together for our Westwood clients to give a snapshot or an idea of what the rising costs actually look like. So in 2022, you see at the top the number says that the cost has increased about 2.31%. In 2022, it's closer to 3%, so it's steadily rising. And then the difference between the top chart and the bottom chart is the top chart only looks at tuition, while the bottom chart includes other costs above tuition. So room and board, fees, supplies, transportation. And then as you go down the list, the number doesn't seem, well, the cost does seem high, but the increase from year to year doesn't seem too wide. But I want to note that you want to add the inflationary adjustment to that number as well. So from 2020 to 2021, if we're looking down at the bottom for private four-year institutions, including cost above tuition, says 2%, but then you also want to add in whatever inflation is, which, as we all know now, inflation has been very high recently. But when we're planning for these in our education projections for clients, then annually we account for a 5% increase, so that in some cases it ends up being conservative, but then it's also accounting for a big jump each year, which we believe is accurate. So I also want to share an anecdotal example of two clients that, well, it's one client that I have, and they have two children, and they're in the Washington, D.C. area, and they are planning for college for University of Michigan, Ann Arbor. The first child is 4 years old, the second child is 6 years old. So their main question is, we would like for our kids, we'd like to plan for University of Michigan as a school for both of our children. How much money should we be putting away in order to afford it? So we go in and plan for how much money has been saved thus far. Most times when the kids are really young, there's no money, at least at that point. And then we can give you output that says to make the goal that you're trying to make, which is funding future college expenses. You can either put aside X amount per month, or you can put aside one large lump sum, and then we're assuming that both the amount that you put away per month and the lump sum, if you're able to do so, will grow at about 5% from market growth. So we're assuming that the funds are going to be contributed and then also invested so that they grow at around 5%. So for these two clients in particular, the first child is age 4 years old. College cost in 2022 for University of Michigan is $68,000 annually. So a child that is 4 years old in 2022 will start college in 2036. And once you adjust that $68,000 figure for inflation, the actual cost in future dollars in 2036 will be about 134,000 versus the
Wow.
68,000. And then the second child is 6 years old. Again, cost of University of Michigan in Ann Arbor, 68,000 annually, but then a 6-year-old is going to start college in 2034, a little sooner than the other child, and adjusted for inflation in 2034, college costs at University of Michigan are expected to be around 122,000. So I think that does a good job of highlighting that even if you're saving, right now, it's very important that you're saving in the right vehicle so that your assets are keeping pace with not only inflation, but the rising cost of education.
Yeah, absolutely. I think, now that we know that inflation is happening, we know that like costs are on the rise for education. So would you say the options are kind of how can caregivers or, adults and grandparents go about addressing this?
Yeah. So I'm gonna show another slide. And this slide is basically highlighting the different options for funding future education expenses. This isn't an exhaustive list, but it covers the main highlights and the top options. So 529 plan, an UGMA or UPMA, Coverdell savings account, and then under mutual funds, we can look at that as just a taxable account. And then coming in fourth behind these, that one of the vehicles that you hear most, aside from the first three, is an educational trust. So when we're talking about the fourth column, let's think of an educational trust. I'll just kind of go down the line and explain the differences between the four of them. And a 529 plan is actually two-sided. So there's the conventional 529, and then there's the prepaid 529. The conventional 529 is what we'll focus on because we believe it's the best option. But then also I'll tell you a few reasons why we don't advise clients to go the prepaid tuition route. And the main reason for that is because so the prepaid 529 plan would be, so we talked before about rising education costs and inflation making the price for education just astronomically large in the future. Well, if you go the prepaid 529 route, you basically buy credits at today's cost and then use them in the future. So you're eliminating market risk and you're eliminating inflation risk because essentially the cost that you pay now should cover whatever cost in the future. The downsides to that plan are there are only around 13 prepaid 529 plans in the US. And then of those 13, all of them aren't even open to enrollment. You have to be a resident of the state in which the prepaid plan that you choose, whereas the regular 529, so Westwood is in Texas, but you aren't restricted to only use the Texas plan. If you see another plan that works better for your family, cheaper fees, better investment returns, then you can by all means go and use that plan. So that's another downfall. And then the prepaid 529 plans lack portability. So with the regular 529 plan, if you have a child who you fund a 529 for and then they either don't use it or don't use all of the funds, then you can transfer the account balance to qualifying family members. So like siblings, the mom, dad, if they want to go back to get their education. There's just more flexibility around transferring the assets that you've built up. And then lastly, the funds in most prepaid plans will only cover tuition and mandatory fees. Whereas if you look under 529 plan here, under qualified expenses, you have tuition fees, books, supplies and equipment, and it's just a lot more flexible. There's also, due to the Tax Cut and Jobs Act of 2017, the ability to pay money towards K through 12 education and not just higher education, but for if you're using it for K through 12, then it's capped at $10,000 annually. Another piece of the 10,000, so that you can also use 10,000, but it's a lifetime number. So over the lifetime of the beneficiary, you can use up to 10,000 from the 529 plan to pay for student loan expenses that you've incurred. So the conventional 529 plan is one option, and you and contribute money. The money is invested. You aren't the investment manager, neither is your advisor. They're similar to like in your company sponsor retirement plan. It's set up for as a menu of investment strategies, and it starts off as age based. So then, for instance, the clients that I told you about that have a 4-year-old and a 6-year-old, right now the investments will be aggressive and mostly tilted towards equities, so that you have opportunity for growth. But then as the child reaches college age, similar to as you reach retirement age in your employer sponsor plans, the account starts to get more conservative and shift from equities to fixed income so that you don't risk losing the assets due to a down market close to the time when you're going to be needing the assets. To couple with that, so 529 and Coverdale accounts both allow funds to grow tax deferred. And again, that's similar to a retirement account where buying and selling within the account does not incur any tax liability. So your investment isn't mitigated by paying tax liabilities for assets within the account. Both of those accounts offer that feature, but the 529 account has a lot more room for contribution. So each at the top here, several plans in excess of 250,000 per beneficiary. So there isn't a hard number for all 529 plans that you aren't able to exceed, but they can grow pretty large. The risk of it growing too large is it getting to an amount that you don't actually need all the education expenses paid for. But again, if you do get to that point where your account has grown too large, you can always transfer it to a qualifying family member. If you look under the federal gift tax treatment, so another difference between these two, though they both grow tax deferred, well, actually, I'll start here, is the qualified expenses. So with the 529, thanks to the TCJA, you can pay up to 10,000 annually for K through 12, but with the Coverdale, you can pay any amount K through 12, but it's more flexibility in regard to K through 12 because as you can see under qualified expenses for the 529, you can only put money towards K through 12 tuition, whereas the Coverdale, you can put the assets that you've accumulated can go to any expenses related to K through 12. The biggest difference in why the Coverdale is losing a lot of traction is because of the contribution limit. So for the Coverdale, it's $2,000 per year for each beneficiary that can be contributed to the account. So that means grandma, grandpa, mom, dad, aunt, uncle, everyone combined can literally only have $2,000 total for each beneficiary's account per year, whereas the 529 plan, and remember these are 2021 numbers, so 2022 is actually 16,000 for the annual exclusion and not 15,000. And then you can make a 5-year election where that just means like you front load the account and put a lump sum in at one time, and that amount is 80,000 over 5 years. And then if you're a married couple, instead of 16,000 annually, it'll be 32,000 annually. And then instead of 80,000, 160,000 if you do the 5-year election. So there's more opportunity for you to contribute to the account. And then also that's respective of each donor, not each beneficiary. So each donor can contribute that much to the account. And as you can imagine, it can fill up pretty quickly if you have the means and family members that are willing to help support, put money towards the child's education. So of those two options, though there are some similarities, I highlighted the differences, and because of that, we really don't use the Coverdale much at all. We more so lean to the 529 always. And then the last thing that I want to point out is what happens if you put money into the 529 plan and down the line the kid doesn't use it, you don't have anyone to give the account to. So it's technically money that you aren't going to use for any education expenses. Where do you go from there? Well, you can always take your principal out, tax and penalty free. And then whatever earnings that you had, remember the earnings have been growing tax deferred. Whatever earnings that you had in the account on top of your principal, you'll pay tax on the earnings, and then you'll pay a 10% penalty for the assets not being used to pay for qualified education expenses. The downside of both of these is that neither grow tax deferred. Grandparents tend to, and for those who might have just gotten on the call, for this last column under mutual funds, we're looking at this as just a taxable account and educational trust. Grandparents tend to favor the educational trust just because they are working with attorneys, getting their estates in order, trying to maintain control over assets once they are no longer here. And if you use an educational trust, the expenses have to be paid directly to the institution. So if the kid is going to University of Michigan, Ann Arbor, the check isn't cut to the grandchild, it's cut directly to University of Michigan. But it gives the grandparent the control over the assets to say, I'm giving my grandchild X amount of money, but it can only be used for education. It can also you can also add more flexibility where you can say these assets are used not only for education, but for healthcare, for other living expenses. So that when you think of educational trust, it's more so about controlling the assets than it is about actually planning for college. And then the UGMA and UPMA account is definitely an option, but I don't personally look at this account as a college savings plan, and I don't talk to my clients about it as a college savings plan. I look at this as just an account for someone who's younger and that will eventually need assets from the donor. And the reason for that is because once the child reaches age of majority, the assets become the child's, and the parent has no say so of what they actually use the assets on. So while you might have intended for them to use the UGMA or UPMA as a college savings vehicle, they might use the money to buy a nice car or something of their choice. So to fund education, these are the top options to consider.
I think this is a really comprehensive and really good look kind of overview at what is, kind of available out there. And so, of all of these, which do you think, and I think you kind of talked on this, but you do believe there is one that is the most advantageous?
Yeah, for sure. And it would definitely be the 529 plan. In the 529 plan, so the reasons are like I said, the contribution, flexibility. Haley can can contribute 16,000. Wes can contribute 16,000. John, Jack, Joe, everyone can contribute until you get to this point. So I like that community approach. And then a lot of grandparents and other family members are usually inclined to help pay for education. The other piece is the fact that the assets grow tax deferred. That makes a huge difference for long-term investing if your returns aren't continually being mitigated by tax liability. And then the I want to point this out as well. So the K through 12 expenses for 529 plans that are capped at 10,000. Some of our clients, well, a good amount of our clients have children who are in private school. So that seems like an interesting feature for them. I would say that in Texas, since we don't have, so 529 plan contributions in some states are tax deductible. But if you're in a state that doesn't have state income tax like Texas, then there's obviously no benefit there. But if you are in a state that has state income taxes and you're going to be paying for private school for your kids, then it might be advantageous to contribute to the five. So instead of just sending the money directly to the school, contribute it to the 529 plan and then get the tax deduction and then pay the school through the 529 plan. You can't have you can't establish a 529 until the child has a social security number. So kindergarten starts around age 5, so that'll give you around 5 years of growth prior to then. But I think the real claim to fame for 529 is that tax deferred growth and the time horizon that you have between being born and going to college at 18. So 18 years of tax deferred growth is really the punchline. And if you aren't going to be benefiting from a state income tax deduction, then that's when using the 529 for K through 12 expenses isn't that advantageous. But the 529 plan is definitely the biggest bang for your buck from the options available.
Yeah, absolutely. And so, kind of just to wrap it up, can you talk to us just about the process of selecting a 529 plan that's kind of the best for each individual?
Yeah, so there's a website and it's very intuitive, savingforcollege.com. You go in, like I said, all the plans are age-based plans. You go in, tell the plan the birth date of the beneficiary of the account, what state you're in, and then it'll give you options it'll give you the options that are available to you. And what you want to look for is the fees. So once you pick like these are the plans that I seem interested in, you want to pay attention to the fees. You want to pay attention to the previous investment performance, and then you want to start with your state plan just to I mean, if you're in a state with state income tax, you want to start with your plan just because of that benefit from tax deductibility. But savingforcollege.com is the website, very intuitive and very easy to start.
That's awesome. I think this has been a really well-rounded, comprehensive look, kind of at like how to look at these education costs and address them. So, thank you so much for being here and for talking it over.
Absolutely. Thank you, Haley.
Thank you for joining us. And as always, if you have any questions, you can reach out to your advisor or visit our website for more information. So, thank you so much, and everyone have a great week.